Today we will be teaching you what every investor should know getting into investing before putting serious money that can impact your life into the market. It is hard to know where to begin with the mountain of knowledge you truly need to understand the markets, but these general guidelines will help give a direction, so enjoy. 1. Risk and return. At the fundamental level, risk and return are two very important considerations when investing. Risk refers to the potential for loss on an investment, while return refers to the profit or gain that an investment generates. The relationship between risk and return often is described as a trade-off, with higher levels of risk generally associated with the potential for higher returns. It is important to understand your risk tolerance and the potential impact of market fluctuations on your investments. Some investors may be willing to take on more risk in exchange for the potential for higher returns, while others may prefer investments with lower levels of risk. Many highly regarded investors are able to weigh in the risk versus potential return and use that to develop an investing strategy to minimize risk while maximizing potential for returns. 2. Diversification. As Warren Buffett always says, diversification is a key strategy for managing risk in investing. By spreading your investments across a range of asset classes, industries, and regions, you can reduce the impact of any one investment performing poorly. For example, if you invest in a single company and that company's stock price falls, your entire portfolio could be at risk. However, if you diversify your portfolio by investing in a variety of stocks, you can mitigate this risk while providing more stable returns. Your portfolio is typically less prone to intense fluctuations as well when your portfolio is well diversified into different sectors as well as stocks. In addition to diversifying your portfolio by asset class, it is also important to consider diversifying by industry and geographic region. This can help to reduce the overall risk of your portfolio and prevent additional stress if big portfolio fluctuations tend to be the type of thing that weighs in heavy on your mental health. 3. Investment vehicles. There are many different types of investment vehicles available, including stocks, bonds, mutual funds, exchange-traded funds, ETFs, and real estate. Each has its own set of characteristics and risks, and it is important to understand the differences between them in order to make informed investment decisions. Stocks represent ownership in a company and can provide the potential for growth through capital appreciation and dividends. Bonds are debt instruments that pay periodic interest and return the principal, original amount, when they mature. The investor becomes a bondholder and is entitled to receive the agreed-upon interest payments until the bond matures and the principal is returned. Mutual funds are investment vehicles that pool together the money of many investors and use it to buy a diverse portfolio of stocks, bonds, or other securities. ETFs are similar to mutual funds, but they are traded on exchanges like stocks and can be bought and sold throughout the day. These tend to be well diversified or can be diversified for a particular sector. Real estate investments can include rental properties, commercial properties, or real estate investment trusts, REITs. You can buy shares in a real estate investment trust, REIT, to own a stake in income-generating real estate properties and potentially earn some passive income. Think of it as a fancy way to become a landlord without having to deal with pesky tenants or leaky faucets. Just like real estate prices, the prices of REITs fluctuate as well. 4. Investment goals and time horizon. It is important to have a clear understanding of your investment goals and the time frame in which you hope to achieve them. This will help you determine the appropriate mix of assets for your portfolio and guide your investment decisions. For example, if you have a long-term goal such as saving for retirement, you may be able to take on more risk in exchange for the potential for higher returns. On the other hand, if you have a shorter time horizon, such as saving for a down payment on a house, you may want to prioritize the preservation of capital over potential growth. Keep in mind the overall big picture. And lastly, 5. Investment fees and taxes. The fees associated with investing, such as management fees and trading costs, can significantly impact your returns. It is important to understand the fees associated with any investment and to consider the impact of taxes on your portfolio. Some investments, such as mutual funds and ETFs, may have higher fees than others, such as individual stocks or bonds. In addition, the tax implications of your investments should also be considered. For example, long-term capital gains, gains on investments held for more than a year, are generally taxed at a lower rate than short-term capital gains, gains on investments held for less than a year. Understanding the fees and tax implications of your investments can help you make informed decisions about how to allocate your assets. Now that you have an idea of what to look at, do not get complacent and turn into another Wall Street Bets loss post. Continue to learn and study, and do not forget how important it is to invest in a way that best fits your situation. One investing strategy can work really well for one person and be potentially detrimental to another. Invest carefully and like and subscribe for more content to hopefully help make you a millionaire with life-changing money one day. For you and your family. Have a good day.